Let's check out a couple of more growth and income stocks now with Todd Bunton, our growth and income stock strategist. Your eye caught a container board company here, huh?
Yeah, I've talked about this one before. It's still chugging along. Packaging Corp of America, PKG is the ticker symbol. They're the fourth largest producer of container board and corrugated products in the U.S. About half of its corrugated products are used in food, beverage, and agricultural industries. But the company's delivered 4 consecutive positive earnings surprises.
Wow.
And that's driven by, they're seeing increase in prices in container board products, and an increase in volumes as well. So a lot going right here, and that's all fallen to the bottom line. And as the company continues to generate more revenue and more cash flow, they've used it to pay down debt because they had kind of highly leveraged here, but they've been paying that down. That's reduced interest expense and also driven solid bottom line beats.
It's a smart move.
Yeah, absolutely. So the company, their last beat was on February 11th, and again, it was another solid beat, and analysts unanimously raised their estimates after that and sent it to a Zacks rank of 1, which is a strong buy rating.
Okay.
And I brought with me the price and consensus chart. You can see the trend in consensus estimates over the last several months has been higher for both 2014 and 2015. So very strong earnings momentum going on here. And if you read some of the analyst reports, they're bullish over the next couple of years for this company as they expect those prices and volumes to continue to increase. Based on consensus estimates, analysts expect about 39% earnings per share growth this year and 15% growth next year. So you've got a good growth story here and good income as well. They pay a dividend that yields 2.2%. Now they did cut that in half during the Great Recession back in 2009. Like I said, they had a lot of debt, and of course they're tied to the economy. The economy slows down. This isn't a name you'd want to be in. But ever since 2010, they've increased their dividend at a 39% compound annual rate. Like I said, 2.2% yield. So that's very solid to go along with that growth.
Right.
And then if you look at the valuation, they traded just 15.5 times 12-month forward earnings. That's in line with its 10-year median, and actually a slight discount to the industry multiple of 17 times. So a little bit of value to go along with the good growth in income here. Could be strong total return potential in 2014. Again, keep an eye on those economic statistics because if those start to turn south, then this isn't a name you'd want to be in.
All right. Speaking of chugging along,
yeah.
Norfolk Southern seems to be doing just that, huh?
Yeah, and this is kind of another economically cyclical company, and they've, well, let me first tell you a little bit about them. They operate over 20,000 miles, mostly on the eastern seaboard. They ship things like, coal, automotives, industrial products. And yeah, they've been doing well. They've seen, decent increases in revenue, mid-single digit, high single digit revenue increases turn into big double-digit earnings per share increases. And that's because they have a high degree of operating expenses, fixed operating expenses. So, any little increase in revenue falls to the bottom line at a pretty high rate. So that nice operating leverage they continue to improve upon even this late in the economic cycle. So they delivered a very solid earnings beat on January 22nd, and they saw solid revenue growth and continued operating leverage, and that prompted analysts to revise their estimates higher going forward, sent it to a Zacks rank of 2, which is a buy rating. Based on consensus estimates here, analysts expect 11% earnings per share growth this year and 11% growth next year. Again, that's all tied to the economy as well. That assumes modest economic growth this year, but you've got good growth if that does play out. Good income too. They pay a dividend that yields 2.4%, and I brought with me the 10-year dividend history, and it's absolutely beautiful. And even though they're very economically sensitive and they have a high degree of fixed expenses, they did not slash their dividend during the Great Recession. And
wow.
In fact, they've increased at a 20% compound annual rate over the last 10 years. So very shareholder friendly here. The 2.4% dividend yield, very solid. And reasonable price too. They trade at 14 times forward earnings. That's in line with its historical multiple, and a discount to the industry at 16 times. So kind of a similar story here to PKG. Could be strong total return potential if the economy continues to improve.
Yeah, do you own either one?
I do not.
All right. More stock picks on our website, Zacks.com, and other investing categories. Check them out. They change often, so check back frequently. With Todd, I'm Terry Ruffolo.